the bond market, and also the miners and silver, because things are starting to look a lot more interesting right now. Am I saying gold and silver have bottomed? Well, it's always difficult, but it looks like they might have. And more importantly, though, I think the market is changing its mind vis-a-vis gold and silver and their safe haven status. We've seen since the war began at the end of February that many out there have been saying that gold is finished as a safe haven. It doesn't protect you financially anymore in times of war and geopolitical chaos and rising yields and inflation. It's almost like they're trying to turn things upside down, like the FT tried to do back in 2004 with his editorial, Going Gold. And we'll look at that as well briefly. Many of you are new to the channel and probably haven't heard of this editorial, which I've been covering for many years. In talking about being new to the channel, make sure you also subscribe to the channel. Make sure you like videos that you like, and make sure you share my videos as well with people you think might enjoy it, or with people that you think need to listen to what I'm trying to warn against. For those of you who might not know, my background is in the bond markets. I worked for 20 years in the government bond market, mainly as a futures and options broker for institutional clients. What do institutional clients mean? Well, it's not the retail sector, but it's more institutions like banks, even some other brokers, treasury departments of corporations, and sometimes high net worth individuals. So, I have a lot of experience in the bond market, and that's been part of my foundation. Gold and silver, that has been something more personal and private. I started buying gold and silver in 2002, mainly because I wanted an alternative to my private pension. Private pension got hit relatively hard back during the dot-com bubble when it burst. I wasn't invested in tech stocks through my private pension, but it affected the whole stock market. And getting involved in gold made me look at gold itself, gold's place in the monetary system, in the financial system, and the fact that it had been removed actually from the financial system, and that we were actually in a debt-based system, a fiat currency debt-based system. And that's why the bond market is so important, because the bond market, especially government bonds, and government bonds are important because they're usually like the risk-free asset in any country, because the government can always print, they can always tax to keep things going. So
ever since the Fed cut the dollar's tie to gold in 1971, the U.S. economy has been running on debt, kept afloat by borrowing that kept getting cheaper. Interest rates fell for 4 decades straight, from Paul Volcker's inflation-crushing 20% rates in the early 80s all the way down to near zero during the pandemic. That long-running bond bull market has now flipped. As of late July 2026, the 10-year Treasury yield is sitting near 4.7%, its highest point since January 2025, pushed up by escalating tension in the Middle East and fresh inflation worries tied to spiking oil prices.
Government bond yields start rising. That's going to permeate through the whole economy. Interest rates will rise not just for government bonds, but also for mortgage lenders, for credit card lenders, or for the borrowers, of course. we've been in a debt-based economy, well, debt-based, consumption-based economy since Nixon closed the gold window in 1971. It really took off after the early 80s because Paul Volcker, stepped in. He stopped the inflation running out of control by letting short-term rates trade as high as 20%. And he didn't fix anything, the underlying problem with this system, which is a debt-based system where government bonds back commercial bank lending, government bonds back government spending. And the reason why it all worked out really well is that after Paul Volcker let the short-term rate go to 20, investors became a lot more confident about the central banks and how they were going to fight inflation. And also cyclically, we went into a bond bull market. So yields had been dropping up until late 2021, early 22. They'd been dropping, let's say, the 10-year yield from like 15.5% in 1981 all the way down to 0.3 in 2020 during the COVID crisis. And now we are, as I speak here, and it's 6:17 a.m. London time. The 10-year yield is now at 4.63, and it's starting to creep up quite aggressively. We are almost at 18-year highs. The 30 years at 5.14. Yeah, I noticed they all went up quite a bit yesterday, and so what happened from 1981 to 2021, so 40 years, was that ever decreasing rates and yields allowed debtors to roll over their maturing debt at lower costs. It allowed borrowers also to borrow cheaply, especially from Japan, and we see that the bond market in Japan is in trouble as well. Borrow those funds and then buy assets. It created the everything bubble that we're still in. And I think actually, the stock market is still holding, but I think the bond market, people need to keep an eye on the bond market because that's very important. I wasn't around in 87, but one of the reasons why there was a crash was that bond yields started going up. No one was paying attention to that. People were just paying attention to stocks. So I think we need to be careful with that. The other thing as well, it looks like the central banks could be losing control of the bond market.
Government bonds aren't just a benchmark to watch. They function as the collateral backing trillions in institutional borrowing, everything from hedge fund leverage to standard bank lending. When yields climb, that collateral gets pricier and shakier, which is part of why analysts are increasingly flagging bond market stress, especially in Japan, where yields have jumped in ways most retail investors aren't really tracking. Some market historians point out that the 1987 crash was preceded by a similarly overlooked bond sell-off before stocks finally broke. Whether 2026's bond volatility is following that same script is still an open question analysts are debating, not something anyone settled on.
And if they do, if yields start spiking more sharply and with more volatility like they did in 2020, right now they're still under some kind of control. We could see the central bank step in. How would they step in? Well, they would probably not call it QE, but it would be money printing. It could be something like a liquidity providing instrument or something like that. That's the other thing that's really important, and it's one of the reasons, liquidity, because government bonds, treasuries, gilts in the UK, and other government bonds in other countries, they're used as collateral for other loans. Let's say a hedge fund owns some treasuries. they will borrow from a prime broker, and they'll use that money to speculate. So if yields are going up, it's going to be more expensive to borrow, to use government bonds as collateral. And I think that's one of the reasons why a lot of the BRICS, Global South countries, are accumulating so much gold, because they see the fiat system under pressure. They see that government bonds, especially Japan, that's the big elephant in the China shop, right? Japanese yields are going through the roof, and they're up to here and that. So they need a new form of collateral, a collateral that is also neutral, that someone can't freeze, and that, of course, is gold. It's been collateral, and it has been a good store of value, a good store of, well, it's also a good form of payment for thousands of years. And that's why in the last these last few days here, we're actually seeing gold go up, which is unusual relative to this narrative that gold has to go down if bond yields go up, which maybe was the case from, let's say, 1981 to 2021, because we were in the bond bull market. So whenever yields went up, it was more like a correction in the bond market, and it kept gold in check. But now that we're in the bear market, I think the whole like mechanism has changed, and we've seen that since the 10-year yield broke through like 1.5 in 2021, 2022. Well, gold at the time was around 1,600, and now we are above 4,100, despite the fact that we are near 18-year highs in the 10-year yield. And in the 1970s as well, leading up to gold's massive rise from like 1973 to 1980, from like around $88 to $880, so 10 times. The treasury yield went from around 4 or 5% to, like, as I said earlier, it went all the way to 15. And despite that, gold and silver went through the roof. Am I saying we're going to go up 10 times in gold, like from 73 to 1981? It's possible. Anything's possible. That would mean $40,000 gold. I'm not saying that's going to happen, but I think, yes, people are going to soon realize that gold is a place of safety, especially in times of war and conflict, especially in times of inflation, which we're going to have in spades, because that's the only way they can keep the system going. Yeah, they're going to try to doctor the CPI, the mean weighted trimmed PCE, whatever they want to do, and they'll try to keep the public in the dark. What you need to watch is the M2. That's still going through the roof. What you need to watch is the Fed's balance sheet and see that their assets, they're still increasing their assets. They're still buying assets. And what that means is that they're creating reserve money out of thin air. And that is inflation. So, yeah, I think this could be big here, because aside from gold and silver doing very well here, despite the fact that yields are going up, we're seeing gold and silver actually rebound along with oil, because Brent crude, September Brent crude right now is 92. Gold this morning is up about $50. It's trading around 41.24. Has been as high as 41.42. Silver has traded up to 60. We're now at 59.60. So they're both up over 1%. Silver did outperform gold yesterday. Today, gold is on underperforming, but not as much. And I've been following these trend lines here, as you can see, in gold and silver. You can look at it on a daily chart or in a weekly chart. I'm using the daily here. You can see that we're breaking above these trend lines that had been big resistance in the last, month or 6 weeks or so. It had been really blocking the price. Yes, it's always possible that the bullion banks come in later on and start bashing gold and silver again, but we'll have to keep an eye on it. I think it's encouraging. We also saw the miners do pretty well yesterday. The GDX ETF, that was up 3.45%. And the GDXJ was up almost 6%. And the SILJ, the Junior Silver Miners ETF, was up 5.6%.
There may be a deeper shift happening in who's holding gold and why. Central banks, especially across BRICS-aligned and Global South economies, have been steadily growing their gold reserves in recent years, a trend many tie to unease about leaning on foreign government bonds as risk-free collateral that can be frozen or devalued through geopolitical decisions. Gold's appeal here comes down to its neutrality. No issuer, no counterparty risk. Some analysts think silver could eventually attract similar institutional interest, though its bulkier storage needs mean that shift, if it happens, would likely play out much more slowly than gold's has.
So, back in 2004, I was going to work on the train, and I was reading the FT. We didn't have smartphones back then. Used to buy the real paper. Used to turn to the editorial section, and I'd been buying gold and looking into the whole thing for a couple of years, and I saw this going gold. The pointlessness of holding bullion continues to sink in, and so I cut it out. When I got to work, I went to the mail room, and they had a laminator. They laminated it for me, and I did write here, the FT editorial, April 16th, 2004. Price of gold was $400.65, as you can see. And this is what the FT said here. Given the pointlessness of holding gold, the speed of its official sell-off scarcely matters. Unless leaching the gold into the market bit by bit somehow maximizes the return to the public purse by limiting the impact on the price, that would imply some irrationality on the part of the market. But then holding gold is irrational in the first place. Perhaps the central banks are right to go slowly. Whatever the speed, the direction is clear. Gold is on its way out as an investment and a reserve asset. Well, we've seen that gold has overtaken treasuries as a reserve asset this year. 3 cheers for that. I'm gonna put this editorial right here, right now, and you can do a screenshot of it or pause the video and read it. It's very interesting. They also point out that central banks had mastered controlling inflation, but we know that since 2021, the CPI has been going up in the US on average by 4.5%. They're supposed to have a 2% target, which is a 2% tax anyway. What we need, of course, is no Federal Reserve, no fiat currency, but sound money, gold, silver, and whatever else people want to use that could be sound. That's what a free market is about. And that's why for thousands of years, gold and silver have survived as stores of value, but they're also like counterparty risk free, and with treasury market volatility, government bond problems, bear market in bonds. Collateral is going to become a lot more risky, government bond collateral. So gold, and I even think silver will come back as collateral as well. Silver is a bit bulkier. Of course, you need a lot of physical, but as the price rises, as I expect it to, I think we're going to start seeing central banks and other financial institutions hold not just gold, but also silver